The ProAct Know-How.
Hi, welcome to this Wednesday webinar from ProAct Partnership. We are titled this time, Death and Expat Taxes. And what we're going to look at is a deep dive into the issues of what is inheritance tax, especially what is inheritance tax for expats. Inheritance tax, when is it applied? It's not just applied on death. Inheritance tax is just a fancy name for capital gains tax. Capital gains taxes are applied when people create a capital event. Now, normally that could be a selling of a house. It could be the selling of a business or some art or anything of value. For those involved in Bitcoin, technically selling a Bitcoin investment or shares investments would also be liable to a capital gains tax. Inheritance tax is generally just applied when somebody dies. Not exclusively true though. So there are different ways to try and pass capital assets onto family. And those asset protections in the forms of gifts can also be taxed during the lifetime. So inheritance tax is always there at 20%, but it becomes particularly painful when, in the event of a family death, inheritance tax is paid. And in countries like the UK, for example, it's paid within 6 months of death, often forcing sales of property or debt to be taken on by the estate. In other countries, the inheritance tax is paid on by the recipient. So the money passes in the estate over to the beneficiaries, who then have the capital gains liability. So that's the essential difference between capital gains tax and inheritance tax. Inheritance tax is just centered around date of death. So if we look at when it applies and how it applies, we'll maybe get some bit more understanding of how it can affect expats. Everyone who's born has a nationality. Many people in this world struggle, become refugees, asylum seekers. We're not talking about that. In the normal course of events, you're born into the country under international law, and you have a citizenship and a nationality from that. You can change that, but changing citizenship or nationality takes time. There are some countries that offer special incentives and special schemes to accelerate that. That's not the topic of this thing, but generally 5 to 10 years would be a time that an expat could live and work in another country and assume a nationality of that country. If somebody has got family roots going back to grandparents, they could get a nationality in another country as well. So an American with Irish grandparents could still get Irish citizenship. Similarly, a Cypriot living in London with Cypriot born parents could get Cypriot citizenship. South Africans, there's a big Greek community there. And in Australia that could get citizenship in Greece or Cyprus. So family roots can determine a change of citizenship, but normally under international law, somewhere between 5 and 10 years, somebody can change their nationality. Dual citizenship is allowed by many countries, but not by all. So, for example, Germany and Austria don't traditionally have dual citizenship, so that's not an option for people to take up, and it's not an option if you're from Singapore. So you can have a Singapore passport, or you can have a British passport, but you can't have both. But if you're French or Irish or Spanish or Cypriot expat, you could have a dual citizenship with a passport from both countries, subject to qualification. But even if you get dual citizenship, you've still not necessarily changed where you're from, where you're born. So what is your domicile? Now, what is Boris Johnson's domicile? He's been in the news a lot, so let's talk about him. Boris Johnson is born of expat parents, so he has got a Turkish grandfather, but he was actually born in New York and did some of his schooling in Brussels. But his parents were British, and so he resides and deems himself to be domiciled in the UK, where he spent the majority of his life. Somebody that's born in the UK of Irish parents could have Irish nationality, dual nationality with British, but because they're born in the UK, they would deem themselves to be domiciled in the UK. Domicile can be affected by your parentage. So somebody born in the UK with Asian parents that have emigrated to the UK could still have a domicile, a nationality based upon their home country of, say, India. But it could also be a domicile as well. It depends how you register that birth and what your circumstances are at the time. But essentially, every person has a domicile. So again, looking at UK expats, your domicile is your birth certificate. Your parents are legally resident nationals in Britain. Then you're domiciled from Britain. And that is different to your tax resident. So an expat can be domiciled in the UK and decide to go and live and work in any other country in the Middle East, for example, or in Cyprus or in Portugal. You change your tax residence, but you don't change your domicile. You still come from the UK. Now, under international law, forgetting about Brexit and EU citizenship, the EU is not a country, but it's got a sort of registration system, an ID system, not a true nationality system, which allows people, EU citizens, to get registered to live and work in different countries. That's not what citizenship's about. That doesn't impact inheritance tax. What impacts inheritance tax is under international law, after 5 to 10 years in different countries with slightly different rules, you could apply for citizenship, and that would change your nationality. After 5 years of living in a country, you can apply for a form of permanent residence, whatever they call that in a particular country, permanent residence or a long-term resident or a settled status. Again, that's not a nationality change. That's just a right to live and work abroad, which expats can get after being in a country for more than 5 years. And shorter than that, you're on a short-term working visa for any period that extends upon beyond 3 months. So once you go beyond that 3-month holiday or business trip stay, then you need some form of resident, retirement, or working visa to live and work in that country. So this is tax residence for somebody that wants to work in Portugal or Spain or Cyprus or the Middle East, becomes under international tax law obligatory after 6 months. And then, as far as expat taxes are concerned, it depends upon the country that you're in. So if you're living and working in Portugal or Spain, the taxes are quite high. An expat can get special concessions for going to live in Italy or Cyprus, but not in Germany. So there's a lifestyle choice of what's best for your family and for your business, and you pay the right amount of taxes in those different regimes. But if you're setting up a plan to extend where you're living and where you're based for whatever your family and business reasons are, that is the place that you become tax resident. So a tax resident, an expat tax resident, will still have a tax obligation to their home country and different rules for different countries. So for UK, for example, if there's a double taxation treaty between the country that you're tax resident in, your tax resident is fully settled in that country of tax residence. If there's no double taxation treaty, then that even though you live tax resident in another country, you're still liable to those UK or those home country tax returns, despite you having a second tax resident. So what does the double taxation treaty cover for the country that you're going to be living in? Now, there's some wonderful countries around the world which don't have capital taxes, which don't have inheritance taxes, and some don't have dividend taxes, and some don't have taxes on overseas earnings, only on a remittance basis. So there's lots of different options. What suits the expat's family and business circumstances? So that's what we look at to try and fit the best tax approach for a person that can be legitimately living and working abroad, protecting their property, their business and their family, not just during the lifetime, but down the generations, which is when we look at inheritance tax. So you can become a tax resident and you can have the protection of a double taxation treaty. But then what if you have a property or a business or an investment portfolio in another country? Where does that get taxed? Now, they get taxed. Somebody's just asked a question and I didn't see the whole question, so I'm not sure what that is. Try me again. The sound might be a bit better now. Is that any better? Oh my, sorry about that, guys. My microphone got caught up inside my jacket, so that's why it was a bit muffled. So I've got my fairy knob out now. So your tax residence dual taxation treaty can protect your income tax and your movable income, but it doesn't necessarily protect your capital income. So under law, there's fixed assets and movable assets, depending on what, immovable and movable assets, real estate and movable estate. So certain assets are deemed to move with you. So if you have dividend income or earned income or bank interest, they're all deemed to be where you are. So if you're doing your work if you're working self-employed sole trader in Cyprus, then your work in Cyprus is taxed there. Your economic work is taxed there. But if you've got a bank account in Ireland or America or England, the interest that's generated from that is also taxed. It moves with you. So your bank account and your investment account can be anywhere in the world, and the interest earned on that is taxed in your country of tax resident, normally under tax treaty. It's not always true. As the South Africans, they've got a very aggressive tax approach at the moment. But that doesn't account for everything. So if you've got a capital asset, such as property or business or investments in another jurisdiction, they will be taxed as a capital gain in your country of where the asset is based. So a UK expat that then goes on to sell an investment property in the UK, or a Singapore expat buying property in the UK and sells that property, has got a capital gains tax in the UK on that property sale, and that can't be avoided. The gain and the taxable event is in the UK, and it is taxed in the UK, even if they are living in another country as a tax resident. If you're a tax resident in the UK and you cash your capital or your financial investments, then those movable and capital investments in the UK will get taxed in the UK. Now, this is the question with Bitcoin. Where is Bitcoin? Where is it based? And the legislation is trying to catch up. And our view at the moment is that Bitcoin is treated as an interest, a capital gain that is where you are tax resident. And so by becoming non-resident, the capital gain can be either deferred or taxed in a different regime. So it is a complex issue. It's one that's worth looking at, which is not for this webinar, but we'll look at that in a bit more detail later on. The key issue is that investment gains follow you to where your country. So if you're in a country where there is no capital gains on investments or income tax on dividend income, then obviously you're going to be better off from a business perspective. So successful British business people like Dyson and Singapore and Jim Radcliffe and Monaco will relocate as expats to those jurisdictions because they have a significant capital gains tax saving when they dispose or cash in shares or capital sales of their business. So, there can be big tax savings if it suits your business lifestyle. And that is generally for capital gains. Capital gains is a good one for British expats because when it's non-property, the capital gain is reported into the UK but not taxed as long as you stay out of the UK for 5 years. So if you're expatting into a country or a jurisdiction with a tax residence where there's no capital gains tax on overseas gains, either because it's not reportable or it's a zero rate, then you can mitigate that capital gains tax liability if that suits your family and business circumstances. Inheritance tax is based on domicile. So a UK expat is still domiciled in the UK. So even if they've avoided capital gains on business and investment and Bitcoin disposals, even if they've not paid tax on interest and savings, a UK expat is technically liable to capital gains and inheritance tax on death because they are UK domicile. Now, the law of this is actually not written down. It's assessed on a case-by-case basis. So there's guidelines, and the wonderful thing about a tax jurisdiction like Cyprus is to get clarity. They made in law what the UK HMRC apply as a rule of thumb. So expats could pay a lot of money, could pay 10,000, 5,000 to UK lawyers to assess whether they're domicile or not and trying to get evidence together to show that they're non-domicile. If you come to Cyprus as a tax location, the definition of domicile and non-domicile are very, very clear, and they're in law. And so you can use that to your tax advantage. And that will give you 0% tax on gains, capital gains, on dividends, and on bank interest for up to 20 years. However, that defined non-domicile status for an expat in Cyprus works in the reverse, because a UK expat, therefore, or a German expat or a French expat is still domiciled in their home country, so that the home country has still got a claim. If you stay outside the UK for 20 years, then you can claim to be non-domiciled. But the test case in law for that is where a guy did just that in Monaco, but then returned in his will to be buried in the family cemetery. And because of that, the UK government HMRC deemed that he still saw himself as coming from the UK and therefore is domiciled. So if you want to sit in your British castle in the Algarve, flying a Union Jack outside, and claim that you're not British, that will be the evidence against that. But there's better ways to do these things. So as long as you're domiciled in the UK, which is from birth, from your family connections and your nationality, then it's hard to lose that domicile. And it could take up to 20 years of living and working abroad. You could pay a lot of money to try and collate the evidence around that. Or you can do the Bill Gates type of approach, the American type of approach, and protect the family and business assets in a trust environment. And that can protect you from local taxes for overseas property and business. It can also protect you from expensive complications of probate cases, or if somebody has an accident or is injured and needs to hand over care and through powers of attorney, you can manage the jurisdictional issues of dealing cross-border by creating a family asset protection organisation that protects the family and keeps the legal control in a jurisdiction that you want, which is legally works for the family and protects the assets against the cost of legal wranglings following probate or death, and also against the inheritance tax. So, and this is how you can do that. So, inheritance tax in the UK has actually got two rates, 20% and 40%. So if somebody's dying, they've just been diagnosed with cancer in the UK, they've got 5 years to live, and they want to give away £1 million, then potentially that's got a 20% inheritance tax that's payable when the gift is made. There is an exemption. There's one lifetime exemption for each person. That's frozen at its current rate, $325,000 for till 2026. So but everything above that is a lifetime gift, could be charged at 20%, even if you're sitting in sunny Cyprus or Bali or Indonesia or any other place around the world. That gift, for a UK domiciled inheritance tax person, is potentially charged at 20% during the lifetime. So you can make gifts without that. Again, there's a limit to what you can do, and over time, that gift can diminish. So the UK are very happy for you to avoid capital gains or inheritance tax over a 5-year cycle. So a managed approach of gifting business and property and investment assets into a protected environment that's safe and secure, controlled by the family. The family trust then allows the inheritance tax on death at 40%, because it's 20% during a lifetime gift. It doubles to 40% on death. You've only paid 20, you pay another 20 on death. And that goes that way as well. The other thing for expats is that it doesn't cover pension funds. Pension funds are their own pension trust funds, and there's special rules for that. And there, depending upon your age, you could end up paying, you could have your own self-managed pension fund. To get to age 80, it varies, the rules are quite complex, but let's say you die at age 80 with your self-managed pension fund, got £1 million a day, you could get 50% tax on that on death, and 50% goes to the family. So 50% gone straight away. So again, you can protect that capital by using your own family trust rather than a pension trust arrangements. If you've got your money gifted away, and you've got it gifted away over time, let's say over 5, 10, 15, 20 years, into a family trust, you can still protect it from UK inheritance tax, even if you go back to the UK, even if you go back to your home country, once the gift is established and the structure is such that you're protected, the capital and its distance, while you've still got control of that through the arrangements, you can then, because you're distanced from that, you can then choose to go back and live in the UK. So an expat can live abroad for 30 years, be claimed to be no longer domiciled in the UK, but the minute that they go back, even if it's because they need a medical treatment during their lifetime, or it's for their own funeral, or just by accident they end up to be back in the UK when they die, they then become liable for that inheritance tax on their worldwide assets. So the only way to protect that is to make arrangements and gift it over a period of time. So it's a long-term strategy. Made on the deathbed, you'll still get taxed for inheritance. But because a family trust could also protect from capital taxes and income tax liabilities, and cross-border legal expenses and administrative expenses, it actually becomes a very cost-effective way of protecting the family's business, property, assets across generations as well as across border. The worst thing we ever see is people that, in a desperate state and, they're suddenly trying to make arrangements to avoid inheritance tax. You can't do it. That you can give away 3,000 here or 3,000 there. You can make charity donations, but the money's lost to the family altogether. It's far better to do a lifetime of pension planning, to have a good pension when you stop work. But similarly, it's far better, especially for expats, to make a lifetime plan to organise their affairs, to protect their family's assets, income and capital gains. So once an expat leaves the UK, they can avoid capital gains on business and investment sales. And if they organise the assets within that family trust, they can, over time, generate sufficient to free themselves from any liability to capital gains tax or inheritance tax of 40%. So that is the approach that we would recommend and guide people on. As expat experts, we've got that long-term expertise to look after people living and working abroad. We've got a retained client service where we offer people ongoing guidance on how to organise their affairs. We're not selling property, we're not selling investments. We're helping manage family and business affairs. And so we're looking at the long term all the time of how to protect your family's assets so that the money goes to your children and your spouse and your family, and not frittered away to the taxman or in expensive legal bills down the years. So our retained clients can get access to that advice online on an ongoing basis. But if you want more specialist administration and setup of your affairs across border and worldwide, ProAct can do that. We're real experts at that. And you need to go along to our website at proactpartnership.co.uk, find out about our retainer service,